This past year, I helped 24 clients move just over $1.3 million out of banks and instead into the strategies that banks would have put that money in. Welcome, my name is Daniel McCluskey. I personally do this as well, and here's how. The first thing we need to look at is what banks are doing with their cash. Now, they have a massive portfolio of money. Of course, when people put money in the banks now have that under their asset list. They're able to invest it, they're able to hold it. So here is how that portfolio looks. Now, generally, they're going to have at least, and I put it here in completely black, around 5% at a minimum of that money in liquid cash. Sometimes they'll get as high as 25%. That's why I have this grayed out area here. But this main area, this not grayed out or blacked out, is the money that's really being invested. This is into things like loans, government bonds, real estate, etc. These, however, aren't going to be as liquid. However, just like you, as a human being, have a bank account. Why? Because you need access to that money to spend and cover your expenses. So do banks. So if banks need money that's liquid, where are they keeping it? Well, are they keeping it in other banks? Because that is an option that they have. Well, no, they're not doing that, nor are they just holding the cash. So where then are they putting this money? That is in cash value life insurance. As a little reference here, Bank of America currently has over $24 billion in cash value life insurance. This is where they keep their tier 1 assets, their serious liquid cash in case of emergencies or opportunities. Wells Fargo, $19 billion in cash value life insurance. And if this is true, since these banks could just keep their money in another bank, why are they not doing that, and why are they keeping this money in cash value life insurance? Well, first let's go into the nature of cash value life insurance. Life insurance policies are all based on what is called an annual renewable term basis. That means that the insurance company, when they issue a life insurance policy, has made a calculation based on your age, health, and gender, how likely you are to pass away at that age, and therefore they're going to make you pay a little bit more to have that, and they're going to take the risk to where if you pass away early, they'll pay you out the lump sum, but they know in the long run, they are more likely to be on the winning side, the profitable side of this bet than you are, and that's how they make their profit, is by doing this at a large scale. Now, you'll notice when they started offering life insurance, the chart looked something like this. You have your cost of insurance in the vertical, and you have the age in the horizontal. Well, as time goes on, the cost of insurance goes up. Well, eventually, people didn't want to pay these premiums and have it get more and more expensive every year. So they said instead, what if, can I pay more up front here and just pay this flat amount forever and have that cover a certain amount of life insurance no matter what? So that's exactly what happened. Now there's life insurance policies where you will pay the same amount forever, and when you pass away, you're going to get whatever the death benefit is. But here's the thing about that. When you pay this much in this specific time, the cost of insurance still only is this much. So what's happening is the amount of money that's above this dot, so this money here on this line that's in between how much it actually costs and how much you're actually paying, is now considered cash value. And that money is going to grow so it can cover the difference later on when you're only paying this, but the cost of insurance is actually this. Well, now this means there is cash value inside of an insurance policy. So naturally, the IRS is forced to define the tax treatment of cash value inside of a life insurance policy. Well, what do they say? They're not going to make this money taxed as earned, because this would defeat the point of this type of life insurance and for all the many people who have this type of life insurance. So instead, the IRS defines in tax code 7702 that the money inside of a life insurance policy grows tax deferred. We also know, which we'll get into here in a second, that when you pass away, that money transfers income tax free. Well, if this is the case and we haven't even gotten to accessing this money yet, people are going to start to ask the question, okay, well, I could pay this much here for all of that time and cover my life insurance until the day I die. What if I paid an even higher amount and then we cut it off, say right here, and then it just stops, but the amount of money that I put in is going to continue to grow to cover the cost of insurance? Well, those policies now exist. There's 10-pay policies, 20-pay policies. And if that's true, people are looking at the Internal Revenue Code and say, what if I did a single premium? What if I just put this much money in and it covers the cost of insurance for the entirety of the policy? This is all allowed within the tax code. From there, since this type of life insurance gets the tax treatment that it does, people are naturally going to ask, well, is there a maximum that I can pay? If life insurance only costs this much down here, is there any way I can pay way up here and just let that money grow and then access the money or let it transfer tax-free when I pass away? Well, while there is a limit to this, this is exactly what you can do, and this is exactly what banks are doing. What they're doing is they are paying money into a life insurance policy, and they want the most amount that's allowed by the Internal Revenue Code to go towards the cash value. They want the least amount that's required by the Internal Revenue Code to go towards the death benefit. The reason being, this means it's still considered life insurance. It's not considered an investment. It's not going to get the tax treatment as a mutual fund would, for example. Instead, this is going to grow tax deferred. It's going to transfer income tax-free when you pass away, and here we'll get into the access. Here's how we use this while we are alive. We access the money completely income tax-free. There's a couple ways to do this. We can withdraw money. Do we think banks are doing this? No, they're not doing this, because you can only withdraw up to what you put in tax-free. Everything above that would be taxable. Why? Because the money is growing tax-deferred. Instead, you can access this money tax-free through policy loans. There's a couple different types of these. There's fixed loans, there's zero-wash loans, there's variable loans. In short, most of these, what's going to happen is you're going to borrow the money at a certain rate of return, and the goal is to earn equal to or more than the number you're borrowing at. Most insurance companies, you can do this very easily, so you can even earn a positive arbitrage on the money that you're loaning out, and now it's all tax-free. Banks understand this. They're doing this with what's called bank-owned life insurance. So eventually, us, as people who put money in banks, the question must be begged, can I do this? Well, not only can you do this, but people are doing this. For example, Walt Disney, McDonald's, Ray Kroc, the founder of McDonald's, J.C. Penney, the Rockefellers, Hillary Clinton, for example, Donald Trump probably does this. He hasn't released his tax returns. However, all of these people decided to cut out the middleman. They said if the bank is taking our money and going and putting it in this spot where it's growing tax-free and they're able to access it tax-free, it transfers tax-free when the insured passes away and blossoms into whatever the death benefit is. Why can't we do this? And they can. So that's exactly what they did. Now I want to show you my own personal policy where I am currently implementing this strategy. Let's look at it. So I've had this policy for just over a year, and instead of just putting money or additional money from a paycheck into a bank, instead I've put it into this cash value life insurance policy. So you see, currently I have an account value of $15.2 thousand, and I have a surrender value. This is the amount that I can access, $13.56 thousand. Now, if I wanted to access this money, all I would have to do is go into my policy portal here. It's very simple. All I do is log in, and I need to access this money, request a policy service or change. Simply scroll down. I'll click request a loan from my life insurance policy, click request a loan, and then I'll fill out this form. You'll see here I can do overnight mailing, so this gets to me immediately. You can say I'll specify the amount of money I want to take out. So here's the amount of loan. Let's say I wanted $1,000, and then I'll say the type of loan, whether it's a variable or a fixed. That money would get mailed to me. I can cash that check. Even if this money has grown, let's say I only put in $6,000 to the policy and it grew to $13,000, do I have to pay taxes on this money? Absolutely not. And the rest of the money that's still in my policy is going to continue to grow, completely tax deferred, and I'm going to be able to continue to access it tax-free. When I pass away, what's going to happen? It's going to blossom into the death benefit, completely income tax-free. You can see in this case here, if I were to pass away, not only would my $13.6 thousand pass on to beneficiaries, but instead $375,100 passes completely income tax-free to my beneficiary. So can I have a card for this policy where I swipe it like a debit card at the store? No. However, if I did actually need access to this money for any sort of emergency or opportunity, all it is as simple as filling out that form, selecting overnight, selecting the type of loan. Now it's coming to you tax-free, it's in your mailbox, cash it, and it's right there. A couple warnings here just before we close out in the video. First is that the policy needs to be structured properly. You'll notice there that I had $375,000 in death benefit for my age and my health. However, I could have set that policy to have $1 million in death benefit for the amount of money I put in, but I didn't do that. I intentionally kept this death benefit as small as possible. The reason that I did that is because, like we showed earlier, we want the most amount, if we're going to follow what the banks are doing, towards the cash value, and the least amount towards the death benefit and the cost of insurance and fees. If that's not the case, if more money is going towards the death benefit than is going towards the cash value, we're not going to see a great rate of return on this money. Why? Because most of our money is just paying for the insurance. Most of it's not going towards the cash value. The only way we're going to see a great rate of return on that money is Well, if we pass away, and that's not the point of doing this. Next here, we do need to realize this is a long-term solution. If someone is looking to use this as an alternative to a bank for the next 6 months, for the next 2 years, it just isn't going to work. These policies are front-loaded with fees. You saw there I had a little over $15,000 in account value. I've actually put $17,600 into this policy. Just like a mortgage where all of the interest is paid up front, same deal with these policies. The first 10 years is front-loaded. After that, that's where those are going to go away. That's where retroactive back to day one. For example, 30 years in, you're going to see less than, most likely, a 1% fee retroactive back to day one, and all of that's happening completely income tax free, no advisor fees. The money is going to blossom when I pass away. So you just have to keep this in mind from the very beginning. It's not a short-term solution. It's not a get-rich-quick. This is something that requires understanding and patience and sticking to the game plan the same way that the banks and the wealthy entrepreneurs are doing. Last thing here, it is not magic, unfortunately. Many people will want to use this for tax-free income, which is fantastic. You totally can do that. Many people will want to use this to maximize their pension. Many people will want to use this as a working capital account for their bank. However, it can do all of these things, but it can't do them all at the same time. So if you're going to start one of these policies, don't try and think that it's going to serve a ton of purposes at once. Instead, say, hey, this is going to be for my retirement. If I need to pull some of this money out early for a business opportunity, for an emergency, I can do that. But I understand if I do that, this is going to have an effect on the amount of money that later I might be able to take in retirement. Hopefully this video was helpful. Continue to educate yourself on this topic. I release videos multiple times a week. Be sure to subscribe, and I will see you in one of those videos. Bye-bye.